Hello, everybody. Welcome to Friday, and as always, looking forward to our session today, and excited to be here and have the opportunity to talk with everybody. Gib, thank you for taking care of the sound and the video check. I really appreciate that. I can see and hear all, said the owl to the sparrow. I like that. That's nice. Uh, as always, feel free if you have a comment that you'd like to share with the group. If you have a question that I can answer for you as we go into our discussion, feel free to unmute your microphone and go ahead and speak up. If you prefer, you can do the same thing that Gib just did and use the questions panel. And I'll be paying attention to that throughout the course of the webinar and trying to try to make sure that we fold any of those comments and questions into the discussion as well. So however you prefer to interact with us, we do want to try to make this an open discussion, open forum, and that way we can benefit from everybody's experience. And Victoria, I'm happy to see you here. Good morning. I'm excited for everybody that's here. Hopefully we'll get a few more coming in as we get things rolling. In any event, everybody is unmuted that is here so far. So how are you doing? Gibb says doing well, and Victoria says beating the heat. That is the question right now, isn't it, Victoria? That's true pretty much everywhere. Excuse me, thinking that it was, still relatively early in the summer. We're not quite to the dog days of summer. The other day, while my grandkids were here, I helped my daughter-in-law take them out to the car, and thought it would be okay to walk out into the street, freshly paved asphalt in bare feet, and that was not a smart idea. But you live and learn, I guess. But yeah, it's definitely a hot summer, much more so than last year and earlier as well. So I'm okay. It was just a reminder that I'm not as indestructible as I believed when I was a teenager, and still want to believe now as a well, not a teenager. All right. Well, let's let's go ahead and get into the discussion. As always, we have a lot to talk about. We don't have, at least the trades that I've been working with, I don't have anything that is scheduled to expire today, but we do have some open positions to review and consider them against the way that the market is moving right now. And So we'll be able to go through those, possibly take a look at some stocks that some of you may be interested in as well. In the meantime, though, let's just kick things off here. Here we are, second week of July, and the S&P 500 here we are pushing up very near to yet another new all-time high. What do you make of that? And Give, that's a great question. I'll answer that in just a minute. Well, we'll talk about a little bit of the broad market here for just a minute. It is interesting to see, the market is continuing to be very persistent and resilient about maintaining this bullish pattern. We've got a trend now that goes all the way back to the beginning of 2023. So we have a long-term downward trend that is very very aggressive. And that's not, I don't say that to imply that that's a bad thing. It's just, if you consider the, Gibbs says, SPY cover your arse. And you know, it does. This is impressive. This is what I'm, the way that I'm going to say it. I'm not. I am not categorically bearish. I do see some signs that inflation is tapering, and and tapering to a level that I'm not necessarily worried about whether or not we're going to start to see interest rate cuts, but I do see it starting to taper to a level. There's a lot of indicators that are now down around pre-2020 levels when it comes to levels of inflation. And so we may be coming down to more sustainable areas now. There's obviously a flip side risk, which is that we plunge straight through those levels and enter a deflationary environment. That's you know, the opposite of the soft landing, the Goldilocks scenario that the Fed is trying to aim for here. So we'll see if that's something they can do. But a lot of those indicators are one of the big reasons we see the S&P 500 continuing to be resilient and continuing to accelerate even the pace of this upward trend. Here's the overall long-term trend, and then if we go back to November of last year, you know, that's a really ugly line. I apologize, but it becomes even more pronounced. The slope of that line implies that it is very ambitious, very aggressive, and yes, from the standpoint of contrarianism, you know, every time it does this, I do start to twitch a little bit, wondering when the next correction is going to come. And correction, to be clear, I'm really talking about maybe something in the area of 5 to 10%, but maybe not much more. But it does make you wonder how much this current rally can continue. And even from the last, you know, real significant pivot low that came down here around May, you know, again, here is this slope. This is a little bit better line than the one I just drew. But again, this is very aggressive. And the more this extends, the more likely it generally should be considered to, at some point, start to retrace some of that. This is, you know, lately, over the last couple of months, this is what the market has considered a drawdown. These are really just very, very small and slight pauses in momentum, which is really interesting. And so, does that mean that it's time to, you know, fine, we're about to pierce a brand new, yet another brand new all-time high after Wednesday did that? Does that mean it's finally time to just jump in and go along with the rest of the market? What are your thoughts? Victoria, I'm liking this bull market. Gibb says, I didn't run the numbers, but I don't like the risk to reward, and that is also kind of where the question comes for me as well. I really appreciate that comment, Gibb. This is I don't care what your method is or what your strategy, how you approach the market. The thing that you always have to consider is risk to reward. And if I'm thinking about this from a short-term standpoint, for example, excuse me, how do I try to evaluate that under current conditions? Well, one of the ways that I could do it, I'm going to use the lines over here on my chart so that I can get some numbers. You know, I can draw a support line here because clearly that acted as a consolidation stabilization phase. And so that is at around 54.46. We also have just in the last couple of days, resistance right up near this current level. Let me just change this color really quickly. And so there's a distance here between these two levels. That we can start to use to think about reward to risk to a certain point. If I have this line at, geez, let me see. If I have resistance, hard to see exactly where that's at. Up here, probably around, let's go ahead and call it, we'll go ahead and call it 56.50, roughly. And we have and support here around 54.50. So there's about 200 points there between the two. Then, you know, just in terms of overall market, with the market pushing very near to resistance here, there's about 200 points of downside. Is there also about 200 points of upside? If we break above this this resistance level, then there's an argument to be made for that. And at that point, support will change. Instead of support being this green line, right? Then it will become, this red line will become new support. Right now it's acting as resistance. If we see a break above that, it should become new support. And so in that case, reward to risk does start to change. But now that we're kind of starting to top out a little bit, we're hitting this resistance and we're not seeing a push above it. There's about 200 points of downside against not a whole lot of upside, at least in the very, very near term. And that is cause, I think, to try to think a little bit more conservatively. If you are in categorically bullish positions and you have nice profits here, this is a really good signal, not necessarily to sell. You may think about taking profits, but at the very least, bringing up stop losses and making sure that you're using a good trailing stop loss for long bullish positions. Okay. Any other thoughts? Any other comments about that? Let's go ahead and if you do, and you just want to put them in the questions panel, I'll see them, and we can always go back to it, of course. Let's go ahead and take a look at some of the open positions that we have going on right now. Start with some things we have on deck for next week. And so we have a couple of put sales and a couple of covered calls, including one that I just placed this morning on USB as it started to rally and is giving me an opportunity to generate some extra income from this assignment that I took at the end of May. That was nice. Barry says, I have a covered call on Conagra expiring today for $29.50. I was assigned on June 21st for the same price and brought in 55 cents on the 24th. So been in it for about 2 weeks on that one. So let's just thank you, Barry. I appreciate that. And here we are. And so the stock is a little bit below that point. So you're a little bit underwater on Conagra at around 28.50 right now. Now it could pick up, you know, a dollar's worth of momentum. That would be kind of atypical for this particular stock, but it's possible. It generally beat expectations, looks like yesterday on its earnings report. although revenues were a little bit lower, earnings were a little bit above. And so it is rebounding a little bit. The nice thing about Barry's trade here that I do like, so let's draw a line here. So this is not exactly the price, right? But it'll be close enough for our purposes. Oops. There we go. And here's the assignment price, which was $29.50. And the stock's down here around $28.50. So again, about $1 underwater, but from your put sale, excuse me, you had the premium from the put sale already to kind of get your cost basis. And he says that on the covered call, he brought in 55 cents on that. So your cost basis has got to be actually not too far from where the stock's current price is, if I'm estimating right, Barry. Between the premium that you brought in on the put sale as well as what you got on the covered call, right? He says, actually, I'm a little above water when you take those into consideration. So that's nice. And you know, this is we do have this this resistance here that it's acting against, but also pretty good support right around in here. You know, so we're starting to see a little bit of consolidation for the stock between this $1 range. That looks maybe a little bit harsher than it is, considering the way that the chart scales. But this is, there we go, that looks a little bit neater now. But that kind of consolidation range really works nicely for, you know, put selling, covered calls, income generation. And Barry, this is what you're doing is a great example of the reason I like to work with these kinds of stocks, and I don't avoid taking assignments, because when they do this, there's opportunities to do exactly what you're doing. So, you know, that's awesome. If it does expire and continues to stabilize there, you're probably going to have another good opportunity for another covered call next week, which is really nice. So I like that. Okay. Oh, and here's Conagra with the moving averages. So this is actually, it's kind of interesting to see the way the moving averages are setting up here. And this kind of goes to the question that Gib asked just a little bit ago. I apologize. It kind of slipped my mind for a moment, but here I'm going to come back to it. He asked if I have any key candlestick patterns that catch my eye. You know, it's easy to say, well, you know, you see like a bullish engulfing candle at any given time. You know, something like when I was taking a look at Cisco this morning. This isn't an open position, it's just a stock that I follow. You know, these are obviously interesting because they really imply there's a lot of bullish momentum that's picking up. But categorically, you know, there's not one single candlestick pattern that I consider to be superior to others. In fact, when all is said and done, it really comes back to, you know, the same kinds of patterns that that we've tended to talk about relative to the way that I like to use moving averages, the 20-day and the 200-day moving average. Looking for things like the bullish level 1, bullish level 2 patterns. And that's where Conagra is interesting right now, because if we look at the 20-day moving average, and you see it starting to flatten, right? That's interesting. It is below the 200-day moving average, but what you see here is a tightening of that range, and then the flattening. That's kind of the primary characteristic that we're looking for here, even if it is a little bit below. And then the 200-day moving average very clearly flattening out. So those are the first indications that an interesting bullish level 1 kind of pattern is setting up. And to be completely transparent, I am reaching a little bit, since it is now below the 200-day moving average. It's just very close to it, so I'm still calling it that. The other thing that we like to try to look for here, relative to candlesticks, is something like a hammer. The signal for acting on a bullish level 1 or a bullish level 2 comes from a hammer formation, and we had that yesterday. And this is kind of an elongated hammer, right? Because we have, here's the candle, which is much larger than on a normal hammer, but look at the length of the wick. And that is, there are some other technical names you can associate with these, but in a lot of ways, this kind of has the same implication as a hammer does, which is bullish momentum is increasing, and should continue to see some confirmation in the candles that follow. We're seeing that today on a modest basis with Conagra right now, but all of that, especially if we continue to see it rally above the 200-day moving average, these are usually leading indications that is that kind of a rally, a push above the 20-day moving average on a traditional bullish level 1, but in this case, above the 200-day moving average is very possible. You get those, and now you're looking at not only a continued extension of this consolidation period, but also very possibly a reversal of the downward trend to the upside for this stock. And so it's starting to look interesting. And I also have a position in Conagra. Again, just in the interest of transparency, I'm in at a higher price than Barry is, and so it's not quite high enough yet to give me an opportunity for a covered call. But if we can see a push above 29, then that opportunity is likely to come, and that'll be nice. That'll be assuming it comes, of course. You know, I'll certainly welcome one more opportunity to use a covered call trade. So we'll see what happens with that one. Talking about next week's positions, though, let's start with Tyson. As we've looked at this in the past, but we see this on this one. I sold the $55 strike about a month ago, and brought in 90 cents on this at the time, so a little over 1.5%. Not a huge premium. You know, I know some of our members, like Ray, usually try to find a little bit more, but certainly good enough for my purposes. And the stock is a little above 57 now. Let's take a look at the chart. Came down until Wednesday, kind of found a good solid support here around 56. And now we're seeing a nice little bounce here over the last few days, just kind of like what we saw with Conagra, Cisco, et cetera. It's kind of following some bullish momentum right now from the broad market to move higher. And that's an okay thing. That means that with the $55 strike price that I sold, that means there may be an opportunity to think about think about maybe trying to work with a rolling trade on this. I brought in 90 cents, and we can see the $55 strike has an asking price right now of 15. There's not been any activity today on this one, which is part of the reason there's 10-cent difference between the bid and the ask on this. If I wanted to try to buy it back, I could maybe try to take the midpoint and go at maybe 10 cents. That would get me out of that position, and once that's done, I could reevaluate and see if I wanted to do something else. Excuse me. The stock is nearing 57.50, and so if I wanted to be aggressive, almost 1% for the next 7 days, that looks like it could be interesting, assuming I were able to get out of the 55 very quickly. If I didn't want to do that, I wanted to be a little bit more conservative. Well, it looks like you're still looking at about a month out, roughly. Let's look at 21 days. Yeah. Implied volatility on these is not really high, so you're still looking at going out about another month to get a premium that is useful enough. There's 90 cents at the 55. So if excuse me, if I like 55 now, and that's the trade that is expiring next week, maybe extending that out for about another month. Maybe that's not the worst idea. I don't know. Maybe there's better out there, and if you think that that's the case, then that's okay too. But that otherwise, this looks like it's in a good position right now. Again, as I've always said, my intention is to let this play out a little bit and see where it goes. Any other thoughts or comments on Tyson? All right. Suncor is also on deck, and so that is also scheduled for next week, another put sale. And so that one I sold the $37 strike price and brought in 60 cents on that one. Comparable return to Tyson, about 1.62%, but for about a 3-week time period. So working with a shorter time frame on that one. Here's the stock now. It had been starting to approach that $37 strike that I had sold the early part of the week. Even seemed to be accelerating towards that a little bit, but has been rebounding in the last 3 days. We do have earnings coming up on this one on the 24th. And so this one will be interesting. And now this trade expires before that, which is nice if you don't like holding an open put sale position through an earnings announcement. But as of now, it looks like we're in a pretty good position on this one. Now, rolling in this case is interesting. It's a little bit of a different conversation, isn't it? Because of that earnings report that's coming up. Here's the option. Here's my strike price at 37. I could buy that back, hang on to 49 cents of my premium. That's certainly more than 50% of what I brought in when I initiated the put sale. But to think about a rolling trade, that the question then becomes, if I don't want to hold that put sale through the expiration date, am I okay with this at 38? Am I willing to be aggressive enough to go for a little more premium at 38.50 and get 49 cents? What about maybe going out a little bit further? Here's the $38 strike price for 2 weeks. Not quite 1.5% for the trade itself, but if you annualize that, excuse me, you're still looking actually pretty attractive on this one. 47 divided by 38 just by itself, obviously not a recommendation, but 1.23%. So it's a 2-week trade. So if you extrapolate that over a month, you're looking at about 2.4% is the opportunity there. But that does this does expire after the earnings report is expected. So we have the 26th on that one. Does that change? Again, I'm asking the question. Maybe it sounds rhetorical, but I'm hoping for some responses here. Is that something that you would be comfortable doing, or would you just say, well, let's wait till after the earnings announcement and see what happens, see what the stock does?
I think it depends whether you want that as one of your, holdings that you want to keep, or you want to, if it's not, you probably want to always wait till after the earnings. That's my opinion.
I think that's a good point, and that does beg the question, right? My approach with these put sales is to always look at them from the perspective of, is this a stock I'm willing to own? Am I willing to possibly own this for a long period of time? And if the answer is ever no, then I don't place that trade. I go find something else. So for me, that's a pretty easy answer, but that can also be an answer that you apply on a trade by trade basis. Maybe you see an opportunity to time, like some of our rollers like to do. You see an opportunity to time a stock's price movement with a put sale, and that's okay, especially if you're going to be going in with the expectation of managing it more actively. Gibb says I always skip earnings, and that's okay too. If it's a company I like and most of the rest of the fundamentals look solid and the value proposition is placed, I'm going to go ahead and I'm going to be willing to place a put sale anyway. Earnings, they do increase volatility, so we can't overemphasize that. So you are going to see price action start to change quite a bit the closer that a stock gets to earnings. That's very typical. But for me, they don't necessarily preclude me from placing that trade, unless there's some other things that make me think that maybe there's a little bit more risk around that than normal, than we would see around a normal earnings season. But thank you, Ray. Thank you, Gibb. Appreciate that. All right. So that's Suncor. If your preference is not to deal with the earnings, then you manage and you're in Suncor, you manage the trade that you've got. Decide if it's a good time to go ahead and buy it back right now. With there's been some activity on this one. Not a ton of volume, but you've got plenty of open interest here. And we've seen a range between 8 cents and 15 cents on that. So, here's a pretty conservative spread between 7 and 11 cents. You could, there's a pretty fair bet here that you could put in if you're in this trade, you wanted to manage it today, and minimize any risk that's coming up in the next week. You know, there's a fair chance if you put in a sell to close with a 7 cent ask that you could get that price. You may have to wait for it. It's a little bit below what the range for the day is, but you know, maybe even setting at 8, setting your trade at 8 cents. Excuse me, that was the last trade, so maybe that makes sense. Close the obligation, free up cash. Then maybe you can keep that powder dry until you decide what you want to do next, whether it's with the same stock or something else. That's not a terrible thought. All right, so those are the 2 put sales. I do have a covered call on Zion, which I've held for, excuse me, a little over a month since being assigned in July or excuse me, June at 43. And so my covered call here is also at 43. So looks like, you know, I'm going to be, if I get called out of this one, it would be at the same price I bought it. That's okay. The trade here gave me almost a 2% return. And that's, again, in the category of good enough. That was good enough. So I'm okay with that. Let's see what it's doing now. Now I looked at this one. I looked at this one yesterday and saw this movement of this rally, and boy, it's only getting stronger, isn't it? Look at this. Look at this break above resistance. That's got momentum behind it. I'm all the way down here. That's Thomas. Really good chance I'm going to get called out here. In fact, the stock has moved far enough away from my stock price that trying to buy it back so I can hang on to the stock would actually be pretty pricey, and probably pricey enough that it just wouldn't make sense to me, especially with earnings coming up right now. Trying to go $3 or $4 in the hole just to hang on to the stock. Don't love that idea. So what do you think? I'm missing out on a pretty big gain here, right? Barry got called out on 628. Should have been more patient, but a gain is a gain. No gain is a miss, is what Barry said, or excuse me, Gibb says. I'm going to go ahead and I'm going to be honest with you, Gibb, I'm going to disagree with you a little bit, because one of the things that you have to factor in when you're going to place a covered call is the understanding that you're putting a cap on how much of a gain you could see. Ray, I'll give you the floor in just a minute. And so, you know, I work with these covered calls with the hope that the stock will show enough momentum to give me a good covered call above the price that I was assigned, so I can factor in a little bit of a gain. But at the same time, if the premium is good enough, and there isn't a clear indication to me that that the stock is going to go above 40, above the price I was assigned, I don't mind working at the same price that I was assigned. Again, here's, you know, 1.86 for 3 weeks of time. That's more than enough for what I need. And so, you know, you do this, you understand here, 43, this is my absolute cap, no matter what happens. And sometimes this is what happens. That's just part and parcel of the system. And so you kind of have to develop that mindset of saying, well, that's what it was. I placed that trade because it was good enough, and it's still good enough. Did I miss an opportunity to make an extra $3 or $4? Sure. But it's not going to change my system. It's not going to change the way that I think or make me feel bad about this trade. I brought in 80 cents in income when I sold that call, and I'm okay with that. Assuming it doesn't fall all the way back and drop below 43 in the next week, you know, I'm going to get called out, and that's going to give me my cash back. I'll have a little bit more powder in the magazine, and I'll be able to keep it dry. That's okay with me. Gabe says, should have said a gain is not a miss. Yeah, when all is said and done, you know, it's, again, thinking about what's good enough, right? A more aggressive trader would agree that no gain is a miss, even if you end up at break even. And excuse me. And technically speaking, you know, if you're trying to figure out probabilities and you're primarily working with shorter term trading, swing trading, and momentum trading kinds of strategies, if I'm trying to calculate, you know, probabilities and success rates in that context, no gain would be counted the same as if I didn't, the same as if I actually lost money. Right, so that would go down as a loss. In that sense, Gib, your first statement was actually absolutely correct. In the context of the way that I like to approach income generation and put selling, it's a little bit different. So, sorry, Ray, go ahead. I know I went on a little bit.
No, I'm sorry. It looks like, I was just gonna say, it looked like the price just broke out, so that's
Yep.
got some room to run.
It is certainly picking up momentum, and it isn't just, you know, these two candles. Here's some more examples of these really impressive, you know, engulfing candlesticks. And when you see these, you know, they should be noteworthy, right? But it's unusual to then see, you know, here's a little bit of a gap up, and boy, did it push higher yesterday. And what we're seeing here, this doji candlestick for today, you know, that's just a little bit of people saying, well, boy, look at that gain. I'm going to go ahead and take that profit. And, you know, that's a little bit of, you're getting a little bit of clearing out from profit taking on this. That's why it's down just a little bit for the day. But there's not so much of that going on that it's putting a lot of pressure on the stock either. Certainly not enough to push it down. To what you're saying, Ray, you know, if we take a look at this on a historical basis, let me expand this, in fact, because let's go to a week. There we go. If I expand these candles out to a week, you know, here we are at the 200-week moving average. Maybe that acts as resistance, but again, it's picking up a lot of momentum right now, coming above this resistance line. And let's see, it looks like there may be upside here all the way to almost $55 per share from where the stock is now. So if we do get that push above the 200-week moving average, which is about 49, could have even further to go. That could be really interesting. One-year chart tends to kind of skew that perspective, right? And it's harder to see a lot of upside. But if you expand that view out to a little bit longer period of time in these cases, assuming the stock isn't, you know, piercing to you know, pushing new all-time highs, then you can usually see some opportunities within that broader range. Barry, yesterday I sold a covered call on CCOI for 65 when it was trading under 63 for July 19th, and I must have motivated it. Let's take a look at that one. CCOI, Cogent Communications. Wow. Bring in $1.80 for a little over a week. And that's nice. You know, Barry, you keep giving me all of these wins you're seeing. So, there you go. You got it, man. I mean, you're just rocking it, which is awesome. That's fantastic. This is, here it was yesterday, sitting around 60 at the open, and then it just really took off. And certainly picking up a lot of momentum now as well. This is one that's not on my watch list, but looks like it, price action aside, here we are with a nice dividend paying tech stock, or telecommunication stock, excuse me. And pretty nice dividend there too, about 6%. Looks like this one might need to go on my watch list and get a hard look. So, thank you, Barry. This is not only good for me, but hopefully for the rest of you. When we see some of the things that everybody is looking at, right? Sometimes that feeds curiosity, and sometimes it opens up opportunities to consider some things that maybe others, you may not have seen otherwise. You've got a different pair of eyes than I do on these, and so this is a good way to share opportunities as a group. So thank you. Now it's in my watch list. All right. The other one that is on deck for next week, this is USB. As I mentioned, this is a trade I just placed this morning. As the stock has picked up some momentum here, kind of like Zion, but not to quite the same extent. Go ahead. Sorry.
Yeah, before you move on, I was just going to say, I think about the time we're taking that Zion, I don't know if you recall, I took BAC, Bank of America.
Yep.
I think I signed at like 26.
At 26?
26.50.
And you're still in it?
Yes, still in it. That's one of my legacies.
Gotcha.
And I'll sell a covered call when it starts reaching its all-time high.
Yeah, you look for an opportunity where it starts to do a little bit of this, right? Get a little bit of consolidation. There's a cover call, then it pushes above. If you can hang on to it, you let that run a bit, because look at the way that this trend has really extended itself.
Yeah, I started at 26.50, so it's starting to get frothy for me. So I might start selling off, but I feel legacy. I like to sell it when we're way overextended.
Yeah, so you've obviously got a nice unrealized gain, right, from 26.50 to where the stock is now pushing close to 42. But you've also got whatever income you brought in from those covered calls, whatever you've been able to hang on to if you've had to buy those back. And you've also got some nice dividends along the way. Here's 24 cents end of the year. Here's another 24 here in March, and 24 more at the beginning of June. So there's another 72 cents of income just on top of that, just from owning the stock.
Yeah, that was I picked it up at the right time.
Safe to say. And it's easy to say that it's easy to assume that you were down in this range, right? Because it's been that long since it was around 26.50. So, all right. That is a very nice setup. Thank you, Ray. And Barry, sorry you don't have the monopoly on tally marks this week. it's a good position to be sure. USB is, as I mentioned, just going back to that one really quick, you know, this is building some good momentum right now. And you know, where I'm okay getting called out at 43 on Zion, which is what I was assigned at, this is a good example of where, you know, sometimes the timing matters when you place these trades and when the opportunity comes, as well as what the stock's momentum is doing at the time. Because when I placed this trade today, you know, I was able to sell the 42.50, so I was able to factor in a little bit of capital gain here. I could be doing a similar thing with USB though to what I did with Zion, you know, putting a cap at 42.50. It is picking up some momentum. And so, you know, what Ray was just saying that he's been doing with Bank of America is a really good comment, because if part of the reason that you are buying these stocks at discounted prices, excuse me just a second. I apologize, had a cough. If part of the purpose in buying these stocks at discounted prices is to hopefully be in position if and when the stock recovers and starts a new upward trend, then selling covered calls into the trend is really something that is going to make you more likely to have to buy that back at a loss than anything else. And so sometimes when you see the stock pushing and seeing an increase in momentum here, sometimes taking the same approach that Ray is might, you know, that also can make some sense, because you wait until you see it top and maybe start to come off of that top a little bit. If we start to see it come down a little bit, maybe start to consolidate, you know, then maybe that may be a little bit more useful for a covered call. Again, from my perspective, I don't mind selling these covered calls into these kinds of moves, because my approach is just simply to focus on the income aspect. So if I can get a little bit of a capital gain, in this case about 50 cents per share on my position, and then I get taken out of the stock at 42.50, that's fine. Anytime I can improve my cash position by getting called out of an open position, I count that as a good thing. And so assuming momentum continues here, it's certainly not a given, considering that earnings for this are coming up on Wednesday and my covered call expires on the 19th. So depending on how the market reacts to that earnings information, I may or may not get called out. It's certainly not a given that it's going to continue to follow that momentum. So we'll just have to kind of let it play out and see what happens. If the market really likes what it's, it could just keep going like that. So sorry, Ray, go ahead.
One of the things about capital gains that I try and do, Thomas, is, you know, am I taking gains on the win towards the end of the year is where I get a chance to dump the losers, so offset my capital, don't pay on the losers. And as you know, we're still holding some losers like Para and others. So that ugly stick, you gotta clean that ugly stick up some. So if you get called out on one good ones and you get some gains, you know, try and save them up, because at the end of the year, you try and clean up your losers, you don't want anymore, so that you set those and you don't have to take tax.
Right. So there's, again, factoring in the impact of taxes and all of those elements. You know, those are all part of your money management strategy and approach. So I appreciate what you're saying, Ray. Just it's going to depend on each individual case. So thank you. Barry says, I made that same trade on USB, but did it yesterday got 64 cents rather than 75. So, oh, I get to give myself a check. Okay. I don't mind that. Thank you. I beat Barry for once. That's nice. All right. So those are really everything that is on deck for next week. I do have some other things coming up here, obviously. Excuse me. 26th is a put sale on Comcast. I just kind of recycled this one after my previous trade had expired and the stock was actually a little bit below when I placed this trade on the 3rd of July, and was able to bring in about 1.9%, again, a little under 2% for about 3 weeks. Again, selling this $37 strike price. And it's, it's not seeing the same kind of benefit from, the market. It's really, it's in a downward trend here. I should have made that a red line, but we are seeing a little bit of bullish movement here, and that's brought it up above the strike price that I sold, which is attractive, and that's definitely helping the trade out right now. It's got a couple of weeks to go yet, so we'll see how that plays out. CMCSA. There's 26. There's my 37. It's really not moved the options price enough. It's still, if I wanted to try to buy that back now, I'd have to I'd get a little bit less than 50% of the total premium that I brought in when I sold the option, right? So probably worth waiting a little bit longer and letting time decay work its magic and see what the price action continues to do. This is one that could certainly just simply continue to extend the consolidation period that we're seeing it start to develop here. Yeah, between about 37, I'm going to go ahead and put it at 39. These are a little bit of an outlier, and they would act as secondary resistance if it breaks above 39. But that's a consolidation range that we'll see how it goes. If it continues to stay in that range, then that's actually really nice for some additional trades. Cover calls, put sales, whatever happens, depending on where the stock finishes. So we'll see how this plays out. But for now, it's just in the middle of that trading range. So I might as well let that play out a little bit more and see what time decay does for it. And then my last one is a put sale, excuse me, that goes out to the first week of August on Hormel. Again, trying to stay a little bit defensively positioned with some of these food stocks like Tyson and Conagra. Hormel was this week's put sale along the same lines, selling the $30 strike, and it's got a little bit of, let me change that to green. It's got a little bit of bullish momentum going here. So that's looking nice so far. Still some time to expiration on that one. I can let that one play out a little bit, and then maybe next week there'll be something different. If it continues to follow this bullish pattern, it is breaking out. This was one when I saw this very, very tight consolidation range, I became very interested. Not necessarily because I was looking for a breakout, just because, again, I like consolidation ranges for income generation. They're useful. And if you do get, the nice thing about some of these is if you get assigned while a stock is really in a consolidation range, you get the breakout above, then you've got nice opportunities with the covered calls. If you never get assigned, then you can just keep placing put sales on those until you see the stock break above, and then reevaluate if the value proposition is still there. So we'll see. All right. Well, we are at time, so we'll go ahead and call it. But as always, I appreciate what all of your comments and your participation in the session today. Hope this has been useful. I know this is always useful for me. I mean, I got I got a nice opportunity to evaluate a new stock from Barry, so that's always a good thing. Always something to be excited about. Barry said, if the dividend would have been more than the premium, I would have bought and sold a covered call. And there is the dividend right there. X date is on Monday, so that's a great comment, and 28.22 cents there as well. So as it is, I'm okay. I'm gonna obviously miss. I'm obviously not gonna get a dividend here if I do end up getting assigned, but that's okay. My covered calls and the other things that we do are usually enough to make up for those, and the dividends are really just kind of a cherry on the top, a little bit of gravy. So, but yes, 55 cents is better than 28, no question. I agree. But as always, everybody, I hope you have a wonderful week. And thank you, Victoria. You have a wonderful weekend as well. Hope that's true for everybody. If you do have something that comes up, you have a question that I can help you out with between now and next Friday, please don't hesitate to let me know. Thomas@investive.co is my email as always. Otherwise, we'll talk again next time. Thanks, everybody.
Thank you, Thomas.
Thanks, Randy.
Have a good weekend.
You too.
Great, everyone.
Thanks, Ray. See ya.